Hello and welcome to today's webinar presentation of Trading the FOMC Meeting presented by Swiftic. As many of you know, coming on Tuesday afternoon or evening, depending where you are in the world, the US Central Bank, the Fed, will be holding its FOMC meeting where they will be discussing the interest rates and monetary policies. So in today's presentation, we're going to give we're going to speak a little bit about fundamental analysis and how you can use that in order to trade during the FOMC meeting. Okay, so first thing we got to do is we got to create our strategy. So we're going to do 3 steps in order to create that strategy. Number 1, we're going to determine what are the expectations going into the FOMC meeting. The best way to be able to trade the FOMC meeting is to have an idea of what are people expecting. Therefore, if there's any surprises, you can be ready to act on those surprises. The second thing we got to do to create our strategy is we have to understand what happened last meeting and what type of impact that had in the market. Because quite often, whatever happened in the previous meeting, if something similar to that happens or something opposite to that happens, we can use that to forecast the types of moves that are going to happen in the Forex market in our upcoming FOMC meeting. Okay, and once we're able to determine what are our expectations and what happened in the previous couple of meetings, we're able to put that all together in order to create our strategy for this upcoming FOMC meeting. Okay, so let's look a little bit about what our expectations are for this upcoming FOMC meeting. Okay, first of all, if you look at FX Street or the Wall Street Journal, or even listening to CNBC or Bloomberg in the last couple of days, you'll probably notice that there aren't a lot of big expectations. No one's really expecting like a really big surprise from the Fed. So probably the biggest expectation is that there won't be any changes in interest rates. That's obvious. They said as much, in the past. So we're not expecting changes in interest rates or to monetary policy. We're not expecting the Fed to come out and say, we're going to have a whole quantitative easing number 3, the QE3. We don't expect that to be happening at this interest rate meeting. But just because the expectations are that the Fed is going to sit tight, Forex traders and all traders in general are still looking for a couple of different signs from the Fed which could affect trading and create a lot of volatility going forward. Okay, so what could the Fed be talking about? So the Fed could be hinting towards new stimulus in the future, or it could update its forecast. So for example, if the Fed goes and says things are really terrible in the EU or in the rest of the world, and we expect that to affect the US and slow down the US economy, even though things have been pretty good in the last 6 months, then they're basically that would mean that they're telegraphing that we are going to apply monetary stimulus soon. Okay, so the Fed could hint towards monetary stimulus, or it could update its forecast and say, hey, listen, I don't care what's going on in the rest of the world. Forget the EU, forget Greece, forget all these these super high yields in Italy. The US is awesome. Employment is coming back. iPads are selling like crazy. We don't care that they're manufactured in China. Bottom line, still money's flowing into the US. And therefore, maybe they're going to update their forecast, which could hint that interest rates will be moving higher in 2013 rather than the expectations of 2014. Okay, but most likely they're probably not going to do much. Okay. So the big expectations. So now we have that down. Expectations are for the Fed not to do anything, but traders are going to be looking for any surprises in their forecasts. Whether they gave a pretty negative assessment of the U.S., which would hint to future monetary stimulus, or whether the Fed is going to give a awesome forecast, and say that GDP is going to be growing, and that would lead to. Well, we'll discuss that what's going to lead to, but. Okay, so we have our expectations for this coming meeting. Next step, let's look at what happened in the last meeting. Okay, so last meeting in January 24th and 25th actually. The release came out on January 25th, and also Chairman Ben Bernanke also gave a press conference and spoke to the public. And what they did there is they really came out with a surprise, because they said that they're going to keep keep interest rates at these near zero levels, and until 2014, which is a long time. And they basically said, we really don't care about inflation. Inflation's not really happening, and therefore we're going to keep applying these low interest rates. Now, they didn't, in the last meeting, they didn't go ahead and say that there was going to be a quantitative easing. But what they did do is they said that the U.S. the economic growth is improving. However, there's still some as they like to use pockets of weakness in the market. Their employment levels are still low, and they were worried. They talked a little bit about the EU, that there might be problems. The fourth problem here, problems about the EU. Therefore, overall, what the Fed basically did is they said, listen, you know what? Things are improving in the U.S., but we're not really so sure how things are going to go out. And by the way, our monetary stimulus has really worked well, and our monetary stimulus worked out very well for the past couple of years. So therefore, they basically said, we're going to leave this cheap liquidity. We're making it really easy for the financial institutions to be able to borrow money in order for them to hopefully, they haven't really been doing it, but hopefully they'll be lending it out to the rest of the economy. And they weren't really too worried about inflation again. Therefore, what this meeting did is it kind of opened up the door and hinted by a lot of Forex traders, and just basically said what the Fed was doing is that they were hinting towards a potential monetary stimulus, another QE3 happening in the future. Why did traders believe this? Because the Fed was saying low, this is number 5 over here, low inflation. So they're saying the Fed talked about how there's still low inflation, and because there's low inflation, they can keep applying monetary stimulus. So that kind of gave the green light to say, oh, okay, there's going to be a lot of this monetary stimulus in the future. Okay, what was the reaction? So the market impact over here. So they said leaving rates unchanged until 2014. So that was a huge surprise. A lot of people, expected to say, 2013 or the end of 2012. But they really hadn't, just said, forget about it. For the next 2 years, cheap rates, we're not going to do anything. On the news, the dollar quickly plunged. It really fell hard over the next few days. Some of the losses of the dollar were really seen against the yen and gold. Gold rose about $100 over there on the bottom. $100 from that should be the opposite way around. It should be 1650 to 17. Rose to 1750 from 1650. The dollar yen, which was hanging around 78, quickly dropped to about 76 before it found support at 76. Also, the euro dollar rose from about 130.40. It was just hanging out around that 130 level, and then it just jumped up to 132.40, and eventually got up to nearly 135 as positive news from Greece came out. However, since that FOMC meeting, which really kind of came and dumped the dollar, U.S. economic figures have continued to do well, especially the non-farms. The week after the week after the January FOMC meeting, the non-farm payrolls were released, and it was a gangbuster. Hit the ball out of the park number. It really blew expectations. No one was, totally caught everybody by surprise. And this happened, and then the following week we had, this whole debt swap things with Greece was going to happen, not going to happen, and then it did finally happen, and then we've had, subsequently we've had all these problems going on with, not everybody agreeing to the swap, whatever. And then probably the biggest things that have really been positive for the dollar is Japan's GDP contracted. They fell, they're closing back into recession, and due to their contraction of the economy in Japan, the Bank of Japan, basically the BOJ, the Bank of Japan, basically said we're going to have to stimulate in order to, get things going in Japan again. So as a result, since that FOMC meeting, the dollar has erased all its losses. It's actually at a 2-month high. not only has it erased all its losses, even made some gains, especially against the yen. This often happens. We have a rotation of money. A lot of money has been going from one safe haven to another. So people, excuse me, people look at the dollar as a safe haven, the Japanese as a safe haven. But now, since things are improving in the US, in the economy, when you contrast that to the really lousy economy in Japan, so that's caused a lot of this money that was in the yen to be rotating back to the dollar. So that's caused the dollar yen to leap from about 82.40 to 82.40 all the way from 76. That's a huge move in the dollar yen. Also, we've seen the euro dollar, because of what's going on in Greece, tank from its 135 level, and it's back around 130. Here's a chart of the dollar yen. You could see that, right here, you can see my little mouse marks there. January 25th, it was right before the FOMC meeting. It was about 78.40, 78.30, and then dropped down to about 76. And then since then, it's just gone straight up to about 82.40. About, what is that? About 8% in a little more than a month. And that's really all has to do with that non-farm payrolls number that just blew the numbers out of the park when it was at 76, and it just kept going higher and higher and higher, along with that negative Japanese GDP news. Similarly, we see the gold, right? We see gold over here was about 1650 all the way back in the end of January, and then it got up to about 1750 after the news. So it went up about $100, and then it kept on going all the way up to about 1800. But basically it really hasn't done much. It's gone about, it's still up since the news, since the last FOMC meeting, but it's been around, kind of trading around 1700, 1720. So gold still moved higher, but it's lost a lot of its initial burst after that FOMC meeting. Okay, so let's put everything together. So we have our expectations. We have expectations that the Fed is not going to do anything, but they are going to, but traders are going to be watching what their outlook are. So we have three scenarios over here. We're going to have we have a possible hawkish surprise, a dovish surprise, or they don't do anything. So it's based on what had happened in the past. We're going to take our three possible scenarios that are going to happen and then come up with a probable outcome that we could trade come Tuesday's FOMC meeting. Okay, so if the first possibility that could happen is a hawkish surprise. If the Fed raises, how would that be? If the Fed raises its U.S. economic outlook, if it hints towards no further monetary stimulus. If the Fed goes out and says things are really good in the U.S., there's no need to do monetary stimulus, we don't really care about the EU at this point, it's enough just to leave interest rates low, we don't have to do any new quantitative easing anymore, and that would be bullish. The probable outcome over here is that would be bullish for the dollar. Specifically, that momentum in the dollar yen would be expected to continue, and we could see like another one of these week or 2 week rallies and see the dollar yen moving up towards 85 as basically that money that's been rotating towards the dollar continues to move. Also, as recently we've seen the dollar gain against a lot of the commodity currencies, so it's, we could see that continue if there's no new monetary stimulus, which means less likely scenario of higher inflation. That would be, if there's less inflation, that would be negative for commodity currencies. So we'd see the dollar gain against the New Zealand dollar and the Canadian dollar. One exception here, if you notice, I don't mention the big commodity currency that people usually talk about is the Australian dollar. I wouldn't recommend or mention any ideas of trading the dollar versus the Australian dollar. It's just because even if the Fed does come out with a really positive number, positive expectation of the U.S., we still have to worry a little about the carry trade and that 4%, 4.5%, 4.25% interest rate in Australia versus the dollar. So if we're going to see losses against commodity currency, I would stick towards trading the dollar against the New Zealand dollar or the Canadian dollar. Okay. And remember, if we have this hawkish surprise, it might not just be a one-day move. It could be it could carry over for several days. Okay, our third scenario, our second scenario, sorry, repeating the hawkish surprise there, is a dovish surprise. If the Fed goes out and actually warns, if they go out and kind of hint that they are going to be doing another round of quantitative easing, or if they actually say, hey, we're starting quantitative easing, or they call it a different name or whatever, then they go out and say we're worried about Europe, unemployment and housing are still weak, etc., then if Forex traders get any hint, or if there actually is if there actually is a real QE3 being talked about, then that would be negative for the dollar. The probable outcome, we're going to see a dollar sell-off. Gold is going to probably climb up to about 1,800. See that previous chart over here, how gold had kind of come down, found resistance around 1,800 and then fallen back down. We could very easily see gold make that move back up to 1,800. And additionally, a lot of the carry trades will get back into fashion. If traders are thinking that there's going to be monetary stimulus, remember after the previous FOMC meeting, traders were expecting monetary stimulus to happen and a QE3 to happen. And in that scenario, right after the numbers came out, after the FOMC meeting, we saw a lot of the carry trade Forex pairs do very well. So again, we can see the Australian dollar or the New Zealand dollar versus the US dollar outperform. Another idea over here is actually shorting the pound Aussie. A lot of times you want to come up with ideas that maybe be like a Forex pair that doesn't give you exposure to the dollar. So if we have this monetary stimulus environment starting up, and traders are starting to think that, hey, maybe there's going to be a lot of this, maybe we're going to get back into the carry trade, then the pound Aussie as a short would also be a good idea over here. In fact, I'd probably even say that shorting the pound, probably the best trades over here would probably be buying gold and shorting the pound Aussie on this news. Okay, the last scenario is if the Fed doesn't make any change at all. They just say, hey, we're going to take a wait-and-see approach, and they do this quite often. A lot of central banks do this quite often. They basically said, we're willing, we're ready to act as needed be, blah 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 blah, or we've done things in the past. Now this over here, the possible outcome is hard. This is the hardest to predict. What if they just say no changes? So it's possible we're going to see a sell on the news on the dollar yen. The dollar yen's performed really good, performed very well in the past month and change. So maybe we see a sell on the news over there. Maybe we don't. I don't know. So that's a really hard scenario. When if the wait and see is hard to get an idea of what's going to happen. But one area one instrument that could do well is gold. If we do have this uncertain market, where a lot of traders, a lot of Forex traders, or traders in general, don't like uncertainty. So if we do have this uncertainty coming into the market, then gold could be a possible winner in this scenario. So we have our three scenarios. We have a hawkish surprise, which would be great for the dollar. Specifically, the dollar yen can go up to 85, and also commodity currencies could be losers. The second scenario is if the Fed is dovish and they worry, if they kind of hint that there's going to be monetary stimulus, that would be negative for the dollar. Specifically, gold could move higher, and some of the carry trade instruments would do well. And then our last one is the Fed just punts the ball and says, forget about it. We're watching, we're gearing up for March Madness, baby. We don't really care about monetary stimulus right now. They could do that, and that's going to be really hard to trade. But gold would probably be the best instrument in that scenario. Okay, so thanks for watching. Also, if you're interested for more Forex trading analysis, please check out SwiftTick at swifttick.com. Have a great day and good luck with all your trading.